Stockland's profits are down 70%. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. I have my stein of coffee and I thought we would look at the significant decline in profits for Stockland from last year. Now if you're not familiar, Stockland is an Australian developer, a large residential builder, but they also have significant holdings in retail, in shopping centres, a lot of smaller shopping centres. Stockland signs on your local shopping centre is a very common sight all around the country. All around the country. Now I ask, is this the retail recession starting to be felt by one of these large property holders? Because how many of these, I've got clients that we're working with, they're preparing material for a lot of these jobs that need to be refurbished. You go to, how many of you have a tired and old shopping centre that just is depressing to go to the mall or has empty shops? Even the malls, the shopping centres are starting to feel it. Yesterday we went to an event, an alumni event at my university, and I was talking to one of my lecturers, and I said, you have to check out this project we did at a well-known, architectural bookstore in the city. We did this whole refurbishment there, and he was going, I buy all my books online now, which is kind of a shame. And I thought that was quite funny because I remember actually meeting him at that bookshop when I was a student years ago, just happened to be there, because that was the Folio Books here in Brisbane. Very expensive for architecture books. They cost a lot of money, and you can burn through a lot of cash doing that. It's the type of place you go to, and you can spend hundreds of dollars on books. Hundreds of dollars. But if you buy them online, they are significantly cheaper. Plug for my Amazon referral link down below in the description, guys. Thank you very much for those of you that have been using it. I appreciate it. But nonetheless, that's an anecdotal story. That's, maybe a sign of the times. I know consumer confidence did go up when we last looked at it from Westpac, Consumer Sentiment Index. But a lot of that, I would hedge or bet, was due to the government's tax handout, essentially, tax deduction. But that went to the middle class, most of it, middle earning. So where do you think that money went? It went to pay down debt. It went to pay down debt. So let's have a look at their Stockland's FY financial year 2019 results. And, it's focusing on sustainable returns. So their funds for operations, FFO, of 897 million is up 4% from last year. Funds for operation per security of 37.4 cents. So that's gone up. So, even though they've made a 70% drop in their profits, statutory profit down 69.6% to 311 million, it's looking like they're okay. They're not at any risk at the moment, guys, but, not financial advice. Maybe they are. I can only look at what I'm saying here, or seeing in front of me right here. Net tangible assets per security of $4.04, down from $4.18. Gearing's at 26.7, and distribution per security of 27.6 cents, up 4.2 on financial year 2018. So let's have a read through here. Stockland Managing Director and CEO Mark Steinert said, "I'm pleased to announce our FFO per security growth for financial year 19 was in line with expectations at 5.1%, despite challenging market conditions." Okay, challenging market conditions. We're going to hear several people mention this in other similar companies that I want to talk about today. Funds from operations were 897 million, an increase of 4% on financial year 18. This reflects a strong performance in our residential and workplace and logistics businesses. Statutory profit was down 69.6% to 311 million, reflecting non-cash adjustments arising from devaluations in our retail town centre and retirement living portfolios, a retirement living goodwill write-down, mark-to-market on financial instruments, and a tax expense change. So there you go. The devaluations of their residential town centre portfolios. And retirement as well, but there you go. There you go. So could this, obviously this is the retail. Well, the valuation of these things, these shopping centres, what's happened is that the tenants occupy, they'll sign on for a particular lease, and they'll pay a particular rate depending on these retail environments. Sometimes they even pay a portion of their profits to the landlord. Depends on the contract. It just seems insane to me from a commercial perspective. But yeah, a proportion of those profits go to Stockland, and the valuation of these properties is based on the number of tenants you have, how much rent they're paying, how long they're in there for. So you could lock people in for a longer term, at a shorter, at a reduced rate, but it can have a better outcome because you want longevity, you want stability. So that's why often a lot of commercial or retail holders will do whatever they can to get people inside their buildings, inside the tenancies. So they'll give you discounts, they'll give you deals. Good coffee. They'll give you coffee, Steins. I'm still looking. People are asking me where they can get some of these. I want to get some branded ones. I'm thinking I'm having to get them from China, guys. I can't find anyone here that's like 50x price difference from the stuff I could buy from China. But if you know of anyone that manufactures ceramics in Australia, send them my way, because I frankly think that industry may not exist in the country other than people in Byron making ones by hand. And I don't think you want to pay $300 for a Stein. So that's how, that influences the valuation of these properties. So if they have to devalue these properties, one could argue that it's to do with a worsening tenant occupation. You just have to talk to a few real estate agents to get a feel of how many of them are trying to get occupancy in these places, or just walk up your own town centre to see all those coming soon signs, and just think how much money that they've invested into these centres. So, but also one thing that Mark believes is that he thinks the market has hit the bottom. He thinks the residential market has hit the bottom, and that now's the time to jump back in. But we'll see if he's right there. Our retail town centre strategy is focused on improving future income, resilience, and growth by divesting non-core properties, so they're selling off, ensuring rents are sustainable, and remixing tenancies to reflect consumer trends around convenience and experience. Our retail town centre development pipeline has been reduced by around 50%. Okay, with a focus on smaller placemaking projects, which will redefine customer experience and convenience. So that's a bombshell there. So if they're reducing their pipeline by retail of 50%, hang on, I need to change to. They're reducing their pipeline by 50%. That is a big deal. Big deal for construction flow-on effects. That's potential work on the book for all the people involved. And this is a major company. So that isn't a sign of confidence to me. Retail town centre devaluations totaled $474 million for the year. 35% of the devaluations were driven by capitalization rate expansion. About half were driven by the softening of growth rates and changes to rental income and capital cost reforecasting, following the implementation of our strategy to remix tenancies and renew some leases at more sustainable levels. The remainder were driven by increased land taxes and rates. So just think there how they're renewing some leases for more sustainable levels. What does that tell you, guys? What does that tell you? And this, we can see here, founded in 1952. So more sustainable levels, I would interpret as more affordable levels for their tenants, because they want to keep them in there. They need to keep them in there. The worst thing you want in a retail centre is to have an empty shop. The second worst thing is to have your shop next to an empty shop. Because it just looks bad. Our core retail town centre portfolio, FFO growth, was positive, and we expect overall retail town centre income to stabilise through 2020 and grow moderately from 21. Importantly, our comparable moving annual turnover growth per square metre was 2.3%, reflecting the benefits of our portfolio improvement strategy. The workplace and logistics market is performing strongly, and our weighting to this business continues to increase via development and strategic acquisition. This is an interesting thing. With the retail sector, what they can do is they can improve the value of their property, and then that, as a tenant, that increases the rent because the property is more valuable. because they've added more to it. I'll zoom in here just so we can see this a bit clearer. Our residential business also performed well, delivering almost 5,900 residential settlements, 8% operating profit growth, and increasing our market share by 3% to 15% nationally over the past 12 months. We are well positioned to benefit from an improving market. However, we expect conditions to take some time to normalize as customers continue to experience challenges achieving loan approvals. Retirement living FFO increased 5.7%, reflecting strong sales in development projects and non-core asset sales, offset by lower established sales in line with broader housing markets. I wonder if Stockland are going to be in a good position, because a lot of their product is at a different density to what we've seen in the apartment sector. So as consumer sentiment pushes away and fear at moving into larger developments, maybe more people will look at these opportunities. Although the video I did earlier about commuting may counter that. I wonder if they've got options with dedicated home office, like a studio out the back. I should have a look at some of their designs. We continue to execute on our strategic priorities during challenging conditions for the retail and residential markets. We've achieved strong momentum with our planned retail divestment program, with 505 million transacted, exceeding the initial 400 million target. And we've finalized a 50% capital partnership for our Aura community. These initiatives are enabling us to accelerate our workplace and logistics development pipeline, which now exceeds 2 billion, and the restocking of our residential land bank to position us effectively for future, Mr. Steinert said. So let's have a look through these highlights. Achieving 505 million of retail town centre divestment. So Bathurst, Cleveland, Caloundra South, Kensington and Toowong, with contracts exchanged for Taronga and Cammeray in July, Jesmond in August, exceeding our 400 million target of non-core retail divestment ahead of the anticipated time frame. So they're getting out of this sector. They're getting out of this sector. What does that tell you guys? Is that another warning sign? Or maybe they're just reshifting to a better product. We will continue to assess up to a further 500 million of non-core retail divestment over time in a disciplined way. So they're looking at getting nearly $1 billion. $1 billion out. So, $1 billion. Wow. That's big news, isn't it? That's big news. Is it just me who's a little stunned at that? Why isn't that talked about more? If Stockland are getting rid of $1 billion worth of their retail malls, essentially town centres, which is shopping centres. Damn. Increased weighing to workplace and logistics, which now makes up 23% of our assets, including 99 million of logistics developments completed in Ingleburn, Willawong and Yenora, on track to achieve 25 to 35% weight for workplace and logistics in the next 5 years. So they're shifting their business out of the retail sector into workplace and logistics. That's interesting. That is very interesting. Acquire remaining 50% share of the Stockland Piccadilly for 347 million, following the sale of our 50% share of 135 King Street, Sydney, including Glasshouse for 340 million. We are progressing development discussions with the City of Sydney for the future redevelopment of Stockland's Piccadilly. Confirmed a 50% capital partnership for our 5 billion Aura mixed-use community on the Sunshine Coast at a 30% premium to book value with Capital Property Group in July. This normalises our weighting to the Sunshine Coast while enabling us to deliver a substantial long-term master planned community with a high-quality and aligned partner. Sale of 3 non-core retirement living villages for a combined total of 60 million. Burnside, Taylor Hill and Kellor retirement villages in Melbourne. Completed 192 million of our 350 million buyback of Stockland securities to help support the resilience of securities returns in the future. Well, there you go. That's interesting. So they plan to buy back $350 million. It's interesting how the buybacks can affect the profitability or the earnings per share of a lot of these businesses. Employee engagement score of 81%, 4 points above the Australian national norm. Continued focus on customer satisfaction, highest level of retirement living residential satisfaction since 2009. Other business units also recorded strong results. Reduced unallocated corporate overheads by 5 million to 651, and a commitment to further reduce our cost base in financial year 2020. So, financial and capital allocation, gearing, 26.7 within the 20 to 30% target range. Weighted average cost of debit of 4.4 for the period. Weighted average debit maturity of 5.8 years. Maintain investment grade credit ratings of A- stable and A3 stable. Renegotiate our debit documentation improving our borrowers' capacity with key terms and conditions updated in line with the market and our peers. Okay. Our Chief Financial Officer, Tiran O'Rourke, highlighted the group's focus on achieving capital management for this part of the cycle. We've sustained disciplined capital management this year, and the strength of our balance sheet puts us in a good position to execute our strategic priorities. During the period, we secured new long-term debt totaling $551 million across both the Australian and US capital markets. These issuances reconfirm our ability to access global debt capital markets at attractive prices and long tenors. Our target capital allocation mix remains on track as we move towards 20 to 30% allocation to communities, 20 to 35% to workplace and logistics, and 40 to 45% to retail town centres, providing a balanced portfolio with long-term and resilient income growth. Commercial property. The commercial property business delivered comparable FFO growth up 2.1% across the portfolio, at the lower end of our forecast, with a high-performing logistics and workplace sector partially offsetting the weaker retail sector. CEO of Commercial Properties, Louise Mason, said, "We have continued to actively reposition the retail town centre portfolio to respond to changes in customer spending habits, with a clear focus on convenience and experience. Our centres are focused on Middle Australia and have a strong emphasis on medical, health and well-being, government and non-government services, technology, fast casual dining, fresh food, household products and family entertainment. To execute this strategic priority, we are remixing tenancies to add growth businesses, rebasing existing rents to ensure sustainable occupancy costs, upgrading centre amenities including car parks, and divesting non-core centres. We have defined core centres as the leading retail town centres in their trade area measured by share of sales. With the ability to evolve to meet future customer needs, the trade area for core centres should have limited competition, above average population growth and strong employment fundamentals. Some of our leading core centres include Green Hill, Wetherill Park and Marylands. We are confident that this strategy, proactively executed by our new highly experienced leadership team, will deliver sustainable growth from our core retail assets over the medium to long term. The other key strategic priority for commercial property is to upweigh our logistics and workplace exposure by upgrading existing properties and through development where sub-market fundamentals support taking this risk. We have added experienced professionals to the team to execute this strategy, and strong progress has been made in relation to logistics developments and progressing approvals for our workplace developments, Ms. Mason said. So, here we go. We'll just do the summary of these. Retail FFO, 432 million, up 1.2%. Comparable growth down, 0.2. Achieved portfolio comparable MAT growth of 2.3. Maintained high occupancy rate of 99.3. Well, that's good. That's good for them that they're maintaining a high occupancy rate. Well, there we go. Now we know why. They're essentially had more sustainable rental costs. Workplace and logistics. Logistics FFO 164 million, up 6.9. Comparable growth 3.9. Workplace FFO 48 million. Comparable growth of 10%, 10.4. Logistics portfolio value increases 13.9 to over 2.4 billion, and workplace portfolio value increases 10% to 800 million, representing a combined 23% of the total Stockland's portfolio. Combined development in Willawong, Ingleburn, Yenora, totaling 99 million, with risk-adjusted IRRs above 10% and FFO yields of 7.5%. So we'll look at communities. Residential operating profit, 362 million, up 8% on 2018. 5,878 residential lots settled, 3,869 residential contracts on hand. Okay, so it'll be interesting to see the settlement of these properties, if they can settle. We saw what happened in Melbourne, where the banks all of a sudden changed valuations or changed risk profiles and then people couldn't settle. Restock pipeline with acquisition in Altona North and Kalkoa in Melbourne. Strength of brand, scale, and land bank has seen national market share up 3% financial year 2018 to 15%. CEO of Communities, Andrew Whitson, said, "A residential business has delivered a strong profit result despite a challenging market." Okay, retirement living. Retirement living FFO, 56 million, up 5.7. Settled 250 dwellings in villages under development. Future growth to be driven through 3,500 development units in pipeline, including 10 new land lease communities identified. Sustainable and innovation, all good. And let's look at the outlook. We'll finish on the outlook. We'll have to look at sustainability. We continue to be a global sustainability leader. We've halved our carbon intensity, investing 33 million in solar power generation across 20 retail logistic properties, and saved over 106 million through energy efficiency innovations. I have looked at a lot of the actual programs that people can use to reduce their carbon footprint, what they're investing in, and if you look into what these actually are, like one of them is indigenous burning, and what they'll do is they will, in remote Australia and the far north, they will just burn the bush. And the theory is that by burning it at a particular time, the risk of bushfire later in the year is reduced. So that means there's a saving in carbon because you're not having the bad bushfire in the future. You're just having a little bushfire here, which makes perfect sense. It's fine, but that's what people are buying. That process, which just should happen anyway, is carbon credits. So you're investing in that. So it's kind of a bit of a, it should be maybe once off to establish it. I would say, sure, to establish this thing, great, but I guess it's smart to do, but is it going to have the impact? And solar power generation, good, they're putting it on their plants, but on their retail, that's probably the smartest place to put it. That's a smart thing, because they need to, that's where it's going to be used. So, Mr. Steinert said, current market conditions remain mixed, with steady employment growth. No. Where's he getting that from? Unemployment has stayed stable. People, anyway, record low interest rates, that's not a good thing. Recent tax cuts and high investment in infrastructure. But there is broad uncertainty driven by reduced credit availability, weak consumer sentiment, and low wage growth. We expect retail FFO to stabilize through financial year 2020, with growth forecast from 21, as our remixing and place-making initiatives enable us to adapt to the structural changes in the retail sector. We expect continued growth from our workplace, place and logistics portfolio, from rental growth and new developments. Our residential business remains well positioned in undersupplied markets in growth corridors close to transport, with 84% of our buyers being owner-occupiers, which is the strongest demand segment. Yeah, and I think it probably will grow. More people will be attracted to your product than to the alternatives. However, despite an improvement in residential inquiry and the market bottoming, we expect the market to take some time to normalize as customers continue to experience challenges achieving loans. So here's the opinion that the market has bottomed, guys. In financial year 2020, we expect to deliver over 5,000 residential settlements, and we anticipate residential profit margins of around 19%, above our through cycle range of around 14%. Retirement living FFO is forecast to grow moderately given improving market conditions, our quality service offerings and new development projects. Based on the above, we forecast flat growth in FFO per security in financial year 2020, noting that market conditions remain variable and we are cautious about the pace of recovery in the residential market. Distributions per security growth will also be flat, and our distribution payout will be at the bottom end of our 75 to 85 target ratio. We remain focused on creating Australia's most livable and sustainable communities, owning and managing leading retail town centres in strong trade areas, and growing our workplaces and logistics portfolio. We are making good progress on the delivery of our strategic priorities and on broadening our capital base to put the business in a good position for the future. We have experienced and highly committed team in place and a clear plan to deliver sustainable returns and build long-term security holder value, leveraging our diversified platform. Okay, so what do you think, guys? The fact that they are moving out of a lot of their retail town centre holdings, nearly $1 billion worth, and they're growing their workplace and logistics, I think is the most interesting takeaway from this. Their profits have tanked 70% down, and they're pulling out. They're selling off non-core assets, already $500,000, and then another $500,000 planned. What does that tell you? It tells me we're in a retail recession, everyone. I mean, they've got a good occupancy rate, 99.3%, but they've had to do that to ensure rents are sustainable. There you go. Well, let me know what you think. Like, share, and subscribe, and let me know if you like this type of content. Because I want to kind of go through a bit of these businesses and try and get an understanding of what's happening. Anyway, guys, I'll talk to you all later. Take care.